Okay, greetings everyone. Thank you for joining. Let's give it a kickoff. Appreciate everyone's patience as we were reassembling in the room. I welcome you all to the webinar, Future of SMB Lending. Now, before we kick off, just very few housekeeping items. Please keep your mute buttons on, as well as do not switch on your video camera. That'll kind of make this process very efficient for everyone. You all will be given enough time for Q&A at the end of this presentation. So we'll request everyone to send your questions through the chat window to the administrator, and we will pick each one of those questions. If the time doesn't allow, we will answer the remaining questions via email back to the attendees. So thank you again for joining. My name is Vinay Bhaskar. I lead credit risk solutions at Scienaptic. Been with the industry for a couple of decades, primarily managing credit risk and ancillary functions on modeling and stress testings for both retail and SMB. Proud to be associated with Scienaptic. We are AI machine learning powered product company, which bring the power of AI to credit processes, headquartered in New York. So for this webinar, just to kind of set the agenda, we are broadly going to look at four key themes. The first one, to give a good grounding on where small business trends are as of today compared to what was there in the past. The summary there, of course, is trajectory on a record high, so we'll see where we are and why we are there. Then we'll deep dive into the level of credit lending available to the small businesses. And this is across the major large/small banks, credit unions, as well as the online lenders. And we'll isolate a few problems that we are seeing in terms of the availability of credit. And then third section, which is of course the heart of this webinar, is what can drive this great lending growth while we manage the risk associated with that lending. And with that, we will review the power of AI as well as machine learning and what are the best practices in the industry to drive growth. Last but not the least, there are other considerations as we get our pedal on the gas for the growth mode. So we will discuss some of the key regulatory considerations specifically as it relates to SMB lending. So that'll be a broad charter for today. And as I said, again, we'll appreciate if you can hold back your questions till we cover all these four sections, and we'll address each one of them individually through the chat window. Okay, just then deep dive into the small business trends. What you see on the slide is the quarterly report published by National Federation of Independent Businesses, kind of the largest consortium of small business lenders. It produces 10 indicators, 10 survey indicators, and summarize it in form of optimism index. Now, those indicators span across the wage market, the sales, capital spending the businesses are doing, and the entire health of the business. Now, if you aggregate all these indicators into an optimism index, what you see on the chart is that overall, the optimism index rose is on a trajectory, upward trajectory since 2008 period, ending at 104.3, where the index is seasonally adjusted to be 100 for 86. Now, this has been the longest trajectory up over the entire history when the survey was taken. And in fact, it's a reading which is among the top 10% of all the readings in the 46-year history of the survey. So quite powerful in terms of where businesses are heading overall. Now, underlying this index, I picked one of the indicators, which is the sales, again, from 74 until January 2020. The graph shows the actual and expected sales volume for these small businesses. And the trajectory is quite clear. I need not explain. It dipped to its lowest during the Great Recession, but then it's coming back up very strongly, the actuals beating the expectations all in all. So overall, compared to last month, the sales up by about 3%. And it's on an upward trajectory. Now, of course, underlying dynamics of job creation, the capital spending, all showing positive for all these indicators. So if we summarize for 2020, the small business sector is off to a great start, continuing with the longest economic recovery on record. And small businesses appear to be confident in filling their open positions, raising wages, and investing in the new capital opportunities within the business. Now, having said that, this trajectory, of course, comes with the biggest risk as of today, which is the coronavirus. Now, net of that, if the virus doesn't take the world down, the outlook for small business in particular for 2020 appears to be quite positive and optimistic. So with that, I want to jump to the second section to understand what is the level of lending available to the small businesses. And again, there I would take reliance on this report published by NFIB. It's again on the x-axis, it tracks what percentage of firms believe that they have access to credit versus net of the firms who believe they don't have access to credit. And you would notice that in general, again, coming out of Great Depression, the net percent of firms who believe that the credit conditions have improved continue to improve overall. So it's only about 3% of the firms who have negative sentiments about the credit availability broadly. But these are general trends. If we dig deeper into the details of what is available or not, there are surveys published by BCBS wherein 44% of employers firms say that the credit availability or securing funds was the critical challenge for them in the last 12 months. And of the overall applicants over the 12 months, 60% of the applicants believed that they received less financing than the amount that they applied for. And the key highlight, essentially, of course, as financial institutions look at the credit profile, one would expect that the financing shortfalls would particularly pronounce for firms with weak credits or unprofitable firms or younger firms, and that's what turned out to be the case. But the funding gaps were most acute for firms seeking the small ticket loans of either less than 100 or 100 to 250,000. Now this chart again by the survey highlights the classic risk management approach to the approvals and the funding. So on this chart, you have 3 buckets of low credit to high credit risk applicants. And this is a survey based on 2019 by the Federal Reserve banks. Now, low, medium, and high credit essentially defined in a combination of business score plus the personal credit score in broad terms. And you would see for low credit risk, about 57% of the applications received all of their funding requirements compared to the high credit risk, which is 8%. So yeah, from a risk management perspective, this is all prudent and makes sense, but it also kind of tells that this approach is quite classic in its nature, that it's leaving a lot of the demands being unmet, primarily by the medium or high credit risk, and especially when this credit risk is estimated using a single FICO score or a single business score without understanding what other dimensions of risk the financial institutions could undertake. In summary, the survey report kind of lists out the key reasons or key challenges the small businesses face when securing credit. The three bars, the green one is for the large bank, blue small, and the orange one for the online lenders. As expected, small businesses face longer wait times getting credit from the large banks compared to the online lenders, and that's kind of simplification of the processes that online lenders have been able to brought to the table. However, there are other areas where online lenders do not rank as well against the large or small banks, especially in the areas of the interest rates being charged or the repayment terms on the loans. So very powerful in terms of what are the strengths / weaknesses of online versus classic lenders across the space, as shown through the survey results. So after giving this context of where small businesses face the challenge, the next question, and which is kind of the core of the webinar there, is that what can drive this great lending growth for all these unmet demands by the small businesses, especially in the low ticket domain, especially in the domain where the credit file is thin, or where the businesses essentially are looking for multitude of loans and not just a cookie cutter solution for their financing needs. So there are a few areas that we have identified that can drive it. The first one, of course, is information. Now, this is one of the reasons most financial institutions, large banks especially, have highlighted that because of the information asymmetry between the small businesses sharing the information and how they assess it, the decline rates or approval rates, in other words, are quite low. And that information asymmetry triggers, especially from opacity of small business performance, because this is not reported. Not all small businesses are publicly traded. So some of them are single person owned, small mom and pop shops. So these are unaudited at times. At best, you can get unaudited financial reports from these small businesses, which are hard to rely on. That's one of the primary reasons for why banks feel there's an information asymmetry. Aside from that, the other critical factor which causes a friction in the information flow is this classic principal agent problem, where only the small businesses know where the disbursed funds are going to get used for. So, and they may use it for a short-term funding loan to get a capital of or machines, for example, and get into a revenue mismatch problem. So your short-term loan, the liability is going to come for disbursements very soon versus the gains from that investment is only over a longer period of time, and hence is a credit crunch. So this classic principal agent problem adds to the complexity of assessing what the true risk of lending to a particular business is. And of course, the third challenge is in timeliness of the data, which while for retail, classic retail, you get it almost on a monthly basis from the major credit bureaus, but for small businesses, it's not that structured. So with all these problems, the perception is that it is the state of the information is what it is, and hence the banks feel satisfied, to say the least, in terms of what their approval rates being, even though they know there's a lot to be done in terms of the unmet demand. Now, the key question to ask is this really a thin data problem as of today? Of course, traditionally, the banks have looked at a variety of sources, all three major bureaus together with PayNet and Dun & Bradstreet, but learning from online lending space as of today, and in terms of what information that they tap into, there is plenty of information in this ecosystem that banks and alike can leverage to assess the risk, starting from essentially some of the cloud accounting tools that small businesses could use, FreshBook and Intuit, and imagine the power of this data if banks have partnerships with these small businesses to share this information directly. Then they would be assessing the cash flow situation, for example, almost on a daily basis. More importantly, or equally important, are the augmented sources coming from the new data providers such as Thomson Reuters or LexisNexis, which are connected to a variety of state or federal agencies to collect the non-financial information on the businesses. And then a new budding source of information is essentially the social media, not necessarily to say that use of it is highly prevalent in the adverse actioning, but this turns out to be quite powerful if there is a pre-selection or a positive action that needs to be done. For example, the reviews made on Yelp, and if through the natural language processing, one could understand what the customer's sentiments or feedback is for, say, a restaurant over a period of time, one can collect up plenty of shop intelligence features in terms of what the sales is going to be if the underlying sentiments are going negative. And last thing which I want to highlight on the thin data problem or lack of it now is this new APIs that banks are able to tap into. One, IRS API, most of you would be aware of 2017 legislation was passed, which mandated IRS to share or open up an API for any small business owner, for example, who signs up to share this information with any lender. So this API, Equifax, for example, has direct links with it. They get the information on the tax history as well as the income and revenue in real time in making these decisions. So that is a very powerful source. And of course, the other information that online lenders especially which are not able to tap into, but large or small banks have an edge over them, is this deposit relationship within a bank. So that all then summarizes primarily whether this becomes a thin data problem or not. Now the question is, how do you connect all these information to create a business 360-degree view and for you to feed into the risk management engine? Now, with all these data sources, the ecosystem is so powerful that one can get not only the details on the firmographics, but the financial performance, the market perceptions, the credit/debit performance, as well as information whether businesses are stacking, quote unquote, the credit and going to default as first party over a period of time. So in summary, in our view, and this is more, in my view, is a thick data problem than a thin data problem as of today. A lot of information is available. The question is, can financial institutions create the smart linkages across all these sources and feed into their decisioning systems? The second dimension of where banks and financial institutions need to kind of focus on is removing the frictions within the process of granting credit. Now, the Federal Reserve research last year found out that small businesses typically spend on an average 24 hours to 36 hours just for applying and researching for credit. And this is because for small and large banks, they fall through what we call as the legacy paper application-based system. Not only do they have to then kind of fill all those applications in pen and paper, but they themselves are not clear on what is the right product for which they have to apply. And even once they apply it, the long wait before they get the final decision from the banks can range between few days to few weeks in certain cases. Now, all that results into high dropout rates, and that's the reason why the survey shows what it shows in terms of the customer experience that the small businesses go through. So the intent here is to isolate the frictions and remove the search costs for the borrowers. And here there's a lot to learn from the online lending space, where they have streamlined all this processes by creating a digital ecosystem where you just fill few fields instead of the entire pen and paper 100 fields, have a list of simplified products to choose from, and then apply it with a minimum documentation requirement at step 1. Essentially, typically in a credit process, banks require a plethora of documentation upfront, which not only creates a lot of inertia for the businesses to apply, but they're not even sure how that information is going to use. So learning from online lending practices, as well as how the ideal scenario should be, the suggestion is to use a multi-stage documentation requirement. And just to give an example, if you are using, the financial institution uses a credit score as one of the filter criteria, and the risk appetite says that the institute is not going to lend below a certain level, and an application comes with that score, that should be more of a pre-screening criteria upfront before even you go to a next stage of saying, give me 3 years of your bank statements or 2 years of returns. So certain filter criteria, which is going to pre-screen applications upfront with minimal documentation, and then follow through at the second stage where more documentation would be needed for verification purposes, should be followed. And then last but not the least, the automated decisioning, leveraging machine learning, is turning out to be quite powerful in the straight-through processing of the results. In our experience, we have seen circa 50% dropout rates even after the application has been approved. So assume approval rate to be 60%, the final funding rate by the financial institution could land up to about 30%. And that's primarily because the final decision was driven by underwriting procedures, which took 7 to 10 business days, within which the small businesses took the loan from an alternative source. So in summary, there's a need to provide a superior customer experience by streamlining the underlying process of application itself. Moving to the critical dimension of the credit decision, and this again is from the survey report on employer firms out of 2019. The left side, as I highlighted before, there are at least 57% of the applicants who feel that some of the financing was not approved. And there were other 40% who saw a decline in some or all of their required financing. But if we zoom into the ones who did not get some or all of their funding, which is 57%, the biggest reason for the credit denial by the financial institution tops out to be the low credit score, followed by too much debt and so on and so forth. The unique one here, not unique from the trend perspective, but the interesting one here again is too new or insufficient credit history. And again, alluding to my earlier point, whether it's a thin data problem in today's world, this reason seems to be quite alarming as one of the main reasons for declining an application, wherein you, as of today, you can get more information about that applicant than maybe the case 5 years back. Other noteworthy factor here is this low credit score. Now, as I mentioned, financial institutions, most of them, majority of them, rely on a single score generated by FICO, or on the consumer side, or DNB, SPFE score coming out of the commercial. Now, while these are powerful scores, but over time we have observed their predictive power to be deteriorating, especially given the fact that we have now more information about these applicants than ever before. So these unilateral or unidimensional score based on linear regression or logistic regression in certain cases rank auto risk, but don't differentiate the risk as much as the new algorithms turn out to be. So the learning essentially from there is the need for a sharper machine learning framework that can discriminate the risk better than the classic scores from the bureaus would. And there we're highlighting 3 key dimensions on how this could be done. One, from the machine learning algorithm perspective, or the credit risk decisioning framework perspective, there's a need for the effective risk segmentation. And that segmentation could be based on the industry, the obligor, what type of collaterals are there, the guarantees coming in, or any lien positions established. The single score, which does not take into account these segmented interactions, is going to create on an average view of the profile of the customers. However, we know that if in certain geographies the industry is primarily based on oil versus others based on trucking, the profile of these two could be very different, not just based on the application itself, but also based on what the macroeconomic trends within those geographies could be. So effective risk segmentation schema is a critical element. The second then is, once we have the segmentation schema established, there is a need to understand the non-linear pattern of interactions between the key credit risk attributes. And there are plenty of them which are coming in vogue, starting from random forest to GBM and to more advanced recurring neural network or long short-term memories. Very powerful for understanding the hidden correlations and nonlinear patterns and differentiating what a good versus a bad could be. One note of caution, I think these techniques, though powerful, I think most banks at this point of time have shied away is primarily because of either they are not adept in implementing, or there's a fear of quote unquote explainability problem coming from the regulators. Now within the industry, especially us, there are a lot of techniques that make these algorithms white box or explainable, which can be implemented seamlessly within the organization. The third dimension for enhancing the credit decision comes from optimally deciding whom to approve and what amount of new exposure to be given. Typically, what we have seen is banks or financial institutions, once they determine an approval or decline, their credit assignment or the amount assignment is based on certain tier or categories of risk, and the slabs are then allocated. However, again, a general solution or a slab-based solution doesn't work for each of individual businesses, as they are unique in their requirements and may or may not meet the risk appetite or return guidance for the banks. So the suggestion primarily there is that how do we integrate the projections on the revenues with the projection of the losses to get to the net return given a level of funding, and how does that return change when the funding level changes, so that you can optimally determine a certain level at which your return on RWA or return on equity, whatever the measure be, is maximized. So that's the critical element on optimization piece. And of course, keeping control limits and sensitivities in place. Not only the banks should rely on an average estimate of what the returns should be in the volatile economy, they should be the control limits on what the upper or the lower returns one could expect if the macro situation changes, and in that scenario, should the funding be allowed or not. So this entire framework essentially optimizes on how the credit decisions can be approved. In our experiences, again, we have seen the approval rates jump up from 50% to north of 65 to 70% as we effectively apply all of these techniques. Okay. This then kind of leads me into what else needs to be considered while we manage growth, and there are critical dimensions, especially coming mostly from a regulatory side. Now, you all are experts in this area, and you know if we draw a parallel between retail and SME lending, there are significant regulatory oversight differences one could prevail. So for example, TILA, Truth in Lending Act, is not applicable in full force to the small and medium enterprise lending, while it is one of the key requirements for the retail. However, the regulators are catching up very heavily in the scrutiny of the small and medium enterprise lending. CFPB, for example, has accelerated its efforts to procure information on what type of loans financial institutions are lending to. Specifically, dissecting them by gender and the minority classes to see if there is any bias coming out of it. So with that as a context, the critical things one will need to get into as we step on or use the AI or machine learning is understanding the adverse action coming out of the credit decision on the ones that get declined. So leveraging explainable neural network or white boxing machine learning is a critical dimension to that area, and ensuring that there's a proper model documentation that one can highlight before any regulatory requirements. That, of course, is paired with our detailed ECOA compliant reports to confirm any bias in the model from a lending perspective. So this is very critical element of the new phase where the growth is heading. And then last but not the least is the stability of this entire framework. As I highlighted, one needs to have the proper controls and sensitivities in place, do confirm the out of time, stress test, validation to ensure that the model results hold out good in extreme situations as they do in the normal benign situations. And that one can attain by having a regular monitoring and retraining of the model at certain frequencies. So what does an optimal end state look like, essentially, then, right? How AI or machine learning can bridge the gaps or expectations the small businesses, financial institutions, and regulators would have alike. And we highlight there are 3 dimensions to getting to what an optimal state is. And those 3 dimensions come from data, analytics, and platform. Starting with ingesting all the information about the business or the associated customer into financial institutions ecospace is the starting point, which feeds then into the sharp analytics of feature creation and predictive elements, which are used in a streamlined platform for your strategy. And as I mentioned, this platform should be a simplified process, preferably online, to get this decisioning done rather than manual underwriting. And this platform needs to have an established integration with your backend and front end so that one can appropriately monitor the outcomes of these decisions. And the last 2 pieces in the circle are essentially the explainability of these decisions from analytics perspective, more coming from the regulators, and the monitoring element, which will feed not only the model documentation requirement, but feed it back to the businesses to constantly train and learn and adapt to the new strategies of the real world. So that, in a nutshell, what we believe the state of small business lending going to be. It's a huge potential in the small businesses. They crave for credit. They are seeing huge challenges in the space. The approval rates don't seem to suffice their requirements. Customer experience is not up to the mark. And then with all the new technologies and data, we believe the financial institutions can take up the challenge and provide the experience that the small businesses deserve. So with that, I would open up for Q&A. As we requested, please share your questions using chat window only to the host, and we'll address it over the line. And any remaining unanswered questions until 12, we'll take it offline. But I think we have ample time, 15, essentially 18 minutes to cover all the questions overall. Okay, so I'm just waiting for the questions coming in. Just for everyone, I think just as a note, yes, we will circulate a copy of this presentation to all the attendees. So please bear with us. During the day, you will have these slides out within 24 hours window. Okay, so the first question that I received as expected is how do we explain, quote unquote, the machine learning models, and given the regulatory requirements, is it easy for neural network? Okay, so let me say two things, right? Neural network by the perception or the very nature are not easy to explain as a logistic regression would be. In the industry, if you research, there are a lot of techniques which are available, such as SHAP or LIME, that decision science could leverage to understand what neural network is doing. However, the fact is regulators generally don't approve of those techniques because those are proxy techniques to guess what your main model is doing. So essentially you're building a model to guess what the main model is doing, and regulators don't feel comfortable with that. From our perspective, there are various methods, of course, as proprietary as well, where one could structure the neural network algorithm on the dimensions of monotonicity and discretization to create a finite space of interactions so that one can gauge what's the marginal contribution for a particular combination of bin to the overall predictive power. So it is quite explainable, regulatory compliant, and I would encourage members here to leverage the power of these smart or advanced machine learning algorithms. Okay. One question we have is, have we implemented an end-to-end solution, something similar to what our last slide had, which I think we're referring to this one, or do you have industry examples? Short answer, yes. I think in our experience, we are working with major top-tier banks within US as well as in Asia Pac, where we have deployed an integrated solution from data, machine learning to the system integration back and forth. Within the industry, I'm not too sure that there are various cases where banks have taken it upon themselves to integrate it fully, but that's our recommendation, that they should get to this stage, because there's a lot of power in simplifying it and leveraging the machine learning elements therein. Okay, the next question, I think I addressed that in my initial pitch, is primarily suggesting what are large/small banks can learn from online lending space and vice versa. Now, there's plenty to learn. Let me kind of refer back to this slide, where you see a sharp differentiation in terms of the pain points that credit seekers have for small banks versus online lenders. Of course, here, as I highlighted, the process wait time or the turnaround time to decide, large banks are is 26% compared to 12 in terms of the responders therein. This is one area where the classic legacy banks can improvise and put together a structure to simplify the process. Online lenders have done it phenomenally well, and with the seamless process therein. Same goes here in the application process. Now, interesting thing here in the application process is small bank kind of neck to neck with the online lenders versus large banks. Now, small banks by very nature rely on the relationships more than what large banks would. Large banks, our experience and the survey results show, treat small businesses more as retail lending, wherein it's kind of one size fit all, cookie cutter solution, ask for 100 fields on an application, and then flow it through the classic risk management toolbox and get the decision. But the reality is, small businesses, though may behave in aggregate like retail, but they have their own nuances. And by that very feature, small banks have been able to capitalize on the relationship which exists within that space. So that's a learning. And here, I think, is a learning for the online lending space. Now, this is more for regulators to kind of assess than I have to comment, but the survey clearly shows that the interest rates or the terms of the loan for online lending seems to be very high or unsatisfactory compared to what the classic banks would look like. I'm seeing the next question says, have you noticed considerable differences across geography in terms of acceptance of ML AI scoring as part of the decisioning process? More inertia in the US? Short answer, yes, there are differences in terms of how the industry is maturing or gearing up to embracing these new technologies. Surprisingly or not surprisingly, US actually is quite advanced in embracing these changes than Asia Pacific region would be. In our experiences working with large banks from across the globe, from Japan to US, we see an increasing order of maturity moving from east to west. Of course, within the region, there are differences, and most of it is governed. I think there's another question coming in on the regulation being different across geography, especially in India. Yes, I think the regulation requirements are not as stringent as they are in advanced world. That kind of dictates the adoption piece of it. But in general, I think we are seeing the maturity, not just in the financial institutions about these machine learning space, but amongst the regulators as well. So last year itself, regulators themselves, there was a guidance by the Fed on the use of machine learning AI, while they didn't kind of negate the risk associated with it. They are opening up to the idea of using the advanced machine learning techniques, provided the documentation or SR 11.7 case for US particularly, they are met. So as long as the financial institutions are able to show the stability of the models and the ACOA compliant reports and fair lending reporting therein, we are seeing more adoption in that area. Now, aside from regulation, of course, other big reason or that some may be more advanced than other is the technology of it. In our experience, it's a perception that these elements require huge processing power or powerful technologies to get deployed. The reality, though, is these are very thin footprint deployments within the bank, and banks can assimilate them in the ecosystem without much changes to their infrastructure. So they should be moving into this space. Okay. Let me look at, okay, so this one is interesting. It said the question on the data, so we didn't look at a lot of data sources on the previous slide. The question is, in our experience, did we see some data sources to be more powerful than another? Interesting. I think it depends. It differs from case to case basis. Bureaus overall, I think there are some which are more predictive than another. I kind of won't go into naming which ones because it can differ on a case by case basis. But given the fact that these data sources are democratized and all financial institutions have access to the same data source for credit decisioning, the power is not as much as, or a differentiation between one financial institution and another is not as much as in the fact that one has 9 sources versus 10, because both of them can have 10. The power of differentiation comes more in how the financial institution is able to aggregate that information and create sharp features to feed into the decisioning. So just to exemplify, a bank which has a deposit relationship with the sole proprietor of a small business credit seeker should tap into the trend of what the deposit turnover / the credit turnover has been in the transaction history, and especially what type of transactions were being made in past 3 months compared to past 6. Were they all discretionary in nature? Was it kind of a gamble, or is it more in a healthcare space? So that kind of highlights the prudence of managing cash over and above the frequency and the latency therein. I hope that addressed the question. Okay. Okay, so slightly longer question. Let me read it. It says, one issue with ML models is the unintended or intended biases in the model, which are difficult to explain. Recent case of Apple credit in US as an example. Another point is the overfitting of the model, which might be an issue. How do we deal with such issues? Okay, without going into the specific use case highlighted in the question on Apple credit and Marcus, the question is fair. The machine learning models, and the perception there is that there are unintended consequences of what the models could look like. Now, as I said, a proper monitoring / dissecting of the model outcomes across your segments or protected classes, which can get an unintended outcome, should be analyzed. So for example, one has to analyze, has there been a challenge with the redlining once the bank is kind of rolling out the offers to a geography compared to another? Is there a disparate impact on gender, for example, women aged between 21 to 25 compared to males? So the bank is proportionately rejecting more applications on female than males because of the model. So all these post-mortem analysis needs to be analyzed thoroughly before a model gets deployed in production. And if there are unintended consequences of these models, as the monitoring or backtesting would show, there would be a need to kind of isolate the reasons or lurking variables, quote unquote, hidden factors that could impact it. Okay. I think there may be time for one other question for the session. Okay, I think it's a very important question. The last one, which I take, is what role do regulators have to play as banks look towards the growth mode? I think I highlighted that in my last. This is kind of wrapping up. Regulators, for especially in the SME space, have had a light touch to the control so far, but they have equal role to play in this space as they have in the retail or consumer lending, especially the fact that small businesses or medium businesses are one of the employment generation for the economy. They need to be protected on the borrowing as much as the borrowers need to, or as much as the lenders need to get protected on their terms. So OCC, CFPB, FDIC, fintech, all these regulators, I think, have an oversight at this point of time, most of them overlapping, but there needs to be kind of structure where there are clear responsibilities on managing what small and medium enterprise regulation would look like. So that's, I think, the work's in progress. The question is when it's going to get deployed. But very critical role the regulators need to have on this one. Okay, I think we are right at the hour. So thank you all for attending the session. We would circulate the presentation by tomorrow within 24 hours. And if there are any unanswered questions, we'll address it via email. If you have further questions that you couldn't put it in the chat, feel free to send an email out and we'll respond it as soon as we can. Thank you again and have a good afternoon.